What is most visible is often also what is most flammable. Howard Mark began the Most Important Thing Illuminated not as a dry guide to investing but as a collection of sharp thoughts, where each chapter is like a piece of map pointing into a land of contradictions. Financial markets. There, wisdom lies not in chasing the news but in the ability to discern the hidden meaning beneath the noisy surface. This is not a book that promises you a formula for getting rich, but an intellectual journey to ask why the majority often fail and the few can go against the flow to excel. That question is not just for investors, it raises a deeper issue. In a world where information is raining down on us, is it not more important to know more, but to see differently? In the very moments when the crowd thinks they are most certain, are they also the most dangerous? And before going into this summary, we encourage listeners to buy and read the book to fully appreciate its content. Because only when you read this book will you understand the problems I am telling you about. Please buy the book and support the author. Now let me start summarizing this book. Part 1. Journey of Awareness and Core Principles. Every investment story begins with the paradox that everyone wants to win. But only a few people really excel, the majority stop at the average level, swept away by the rhythm of the crowd. As for the rare people who achieve excellent results, they are not only good at calculations but also possess a different type of thinking. What I call second-level thinking. Sounds simple but think about it. Level 1 thinking is often linear and superficial. Buy good companies, sell bad companies. But life is not that simple. A good company may be overvalued, the stock becomes a sweet trap. A hated company can hide opportunities when the price has fallen to irrational levels. A level 2 investor will ask different questions. What people think and where they go wrong. The market is like a playground where millions of eyes follow every news that appears. Immediately thousands of hands pressed the buy and sell button. If you think like the crowd, you will never be better than them. You have to be both different and authentic, a difficult combination, but it's the only door to lasting success. I remember a period when people panic sold when the economy was gloomy. Level 1 thinking screams, run away. But a level 2 thinker calmly asks himself whether this fear is exaggerated. Has the market gone too far from reality, and it is in such chaos that rare opportunities appear? Conversely, when everyone is happily buying in, believing that this time is different, the level 2 thinker steps back and whispers, perhaps it is when everyone is most optimistic that the risks are highest. Investing is therefore not a formula game. It's like art, where intuition, sensitivity, and the ability to read human psychology are more important than mathematical equations. And that art requires not only knowledge but also an attitude of constant skepticism, of constant questioning, of always looking at everything through a second mirror. Here we enter a controversial concept. Efficient market. This theory believes that all information is immediately reflected in prices. That means stock prices are always fair, no one can continuously profit from market mistakes. If that were true, all the analysis and brainstorming would be for naught, but reality doesn't work as smoothly as books. Remember the 2000 commodity bubble when it shot up to $237 and then crashed back down to $11 in just over a year. If the market is truly efficient, both of these prices would be correct. Obviously not. The market is like people, sometimes drunk, sometimes panic, and that is when the gaps appear. To see that gap, again, we need second-level thinking. Because only then can we escape the collective psychological maze, be sober enough to ask if everyone has gone too far and do I dare to go against them. But understanding value is the foundation. The intrinsic value of a business does not change as quickly as the mood of the crowd. It is like an underground stream, quiet but persistent. While surface prices fluctuate, sometimes hot, sometimes cold. The investor's job is not to be fooled by the numbers on the screen, but to patiently find out what the company is really worth on the inside. Investing, after all, is a game of price and value. You only win when you buy below its real value and sell when it goes far above it, but the trap is that the price fluctuates. Value, on the other hand, requires patient study and is sometimes difficult to determine. It is this difference that creates profit or loss for those who enter the game. The most dangerous thing is to equate risk with volatility. Many people think that volatile stocks mean high risk, but the truth is that risk lies not in the price rhythm but in the possibility of permanent capital loss. An investment can be volatile but still be safe if its intrinsic value is solid. Conversely, a seemingly stable amount can be dangerous if it is based on illusion. And here comes the hard part. Risks are often not immediately apparent. It is like darkness, only revealing itself when the light is too late. During the boom years, everyone thought the risk had disappeared, but that's when it accumulated little by little until it exploded into disaster. Level 2 investors know that the biggest risk is when everyone believes there is no risk. Risk control thus becomes the pillar of every investment philosophy. We can't get rid of it, but we can build a fence. A true investor is not judged by the moment of high profits but by the ability to survive the storm, the survival through the crisis. Preserving capital while others go bankrupt, that is the sign of a master player. When things seem safest, the risks are often at their highest. And conversely, when fear prevails and the press is filled with false news, opportunities often quietly appear. This is not a baseless risky advice but a repeating pattern in market history. Think back to the years before the 2008 financial crisis. Things looked bright, credit was easy, housing prices were rising, and people were borrowing. Just when everyone thought failure was inevitable, the seeds of disaster were ripe, and when the bubble burst, seemingly safe loans turned into rocks that dragged the whole system down. This illustrates the lesson clearly. The feeling of security is often the most dangerous illusion. To become a risk-aware investor, you must train yourself to have a different perspective, not just look at the flashy numbers but look deep into the gaps where subjectivity is hiding dangers. Risk is not present in fluctuating numbers. It lurks in false assumptions, in overconfidence, in the belief that this time will be different. The art of investing therefore lies not only in choosing what to buy but also in being able to say no at the right time. Many times, seemingly golden opportunities are actually glittering traps. Recognizing risks requires a vigilant instinct, almost like a soldier walking through minefields. Every step must be considered, not to be mesmerized by the peaceful silence before the explosion. But knowing the risk is not enough, we must learn to control it. Here is the cold truth: no one can eliminate risk completely. Anyone who promises that is either naive or a liar. The only thing you can do is define a boundary. How far are you willing to go and where will you stop? Risk control is not like playing a game of chess thinking only about winning, but like a commander having to prepare a retreat plan before attacking. Every buying decision should be accompanied by the question: if things go against my expectations, how much will I lose? Can I stand it? Do I have a chance to survive? The great investors I've met don't brag about their big wins. They often talk more about capital preservation. Because profits can be lost in a cycle. But survival over decades makes a career and wants to survive. You must be afraid. A sobering fear. Enough to not rush into the fire just because you see a flash of light. There is an important concept: risk is not measured by the past but only perceived by the judgment that a stock can increase continuously for many years. But that says nothing about the future. On the contrary, it is the long increases that make people forget about the risks. So investors have to build their own invisible radar, always scanning for signs of complacency, of collective euphoria, of popular belief. Investing is not a game of finding profit at all costs but a game of balancing profit and risk. Anyone who only focuses on profits and forgets about risks sooner or later will pay the price. The great investor is not the one who makes the most money, but the one who knows when to stand aside and when to save for the long haul. There is a fatal mistake that most people make. They think that price is value, but price is just a number displayed on an electronic board, changing every second according to the heartbeat of the crowd, while value is silent, sustainable, hidden deep inside the business. Rarely appears immediately. You stand in front of a house, today buyers jostle and push the price sky high, tomorrow bad news spreads, everyone runs away, the price falls to rock bottom. But the house is still the same, still bricks, cement, same location, same profitability, value does not change as quickly as human emotions. But how many investors have mistaken collective emotions for truth? Profit in investing essentially comes from the gap between price and value. When you buy an asset for less than its true value, you hold a margin of safety. When the market comes to its senses and pushes the price back closer to value, profits will automatically come. Conversely, if you buy something just because it's hot, you're betting that the hype will last, but history shows that hype always fades. I remember Ben Graham's words. Warren Buffett's teacher is short-term, the market is a long-term voting machine. It is a balance, meaning that in the short term, prices are driven by election sentiment. Whoever shouts louder will dominate, but in the long run, the true weight of values will speak. Successful investing is about patiently waiting for the scales to give their verdict. But there is a dangerous enemy lurking, risky. And the risk is all the more dangerous because it often lurks behind a sweet shell. People think that volatility is a risk, but I have repeatedly stressed that volatility is not a threat but an opportunity. The real risk lies in the possibility of permanent loss of capital. An investment can fluctuate wildly and still be safe. While a seemingly smooth investment can lead to disaster if its foundation is hollow. Risk identification is like looking in an open mirror when the market is excited. The warning signs are hidden. For example, during a real estate bubble, everyone believes that house prices can only increase. Risk is that collective belief. On the contrary, in a crisis when fear prevails, everyone sells. Real risk is much lower than many people think. This paradox is the key to understanding how the market controls risk. So it is a silent art. You don't need to show off sky-high profits. What you need is a solid defense system, like an architect building a bridge. No one praised him for keeping the bridge standing every day. Only when the storm arises is that safety seen. A good investor is one who builds financial bridges strong enough to withstand wind and rain. And that control begins with an attitude of humility. The investor who believes he can do no wrong is often the one walking the tightrope without looking down into the abyss. Meanwhile, the cautious person always assumes that he might be wrong and prepares an escape route. It is that humility that saves them in crises where others collapse. In a game of chess, an inexperienced person only looks at the immediate winning move, while a master, before making a move, considers the worst-case scenario. If we lose this piece, is there any way to turn it around? If the opponent suddenly counterattacks, I still have investment options. It's not who earns the most that's good, but who stays strong after decades of turmoil. When we talk about risk, we often think of dry numbers, percentage volatility, beta, standard deviation. But for me, risk is not in the chart, it lives in human psychology, in complacency. In the moment people stop asking questions, observe how a tsunami is initially formed. The sea was calm, even beautiful, making everyone think it was safe. But that very calmness is a sign of the enormous amount of energy accumulating at the bottom. In investing, too, when the market is too calm, when profits seem easy, when investors smile believing that the risk has disappeared, that is the most dangerous time. A man who can see danger does not need to see blood to believe in war. They have to read small changes in language, in behavior, in subtle shifts in market sentiment. Sometimes just an unusual increase in greed or an absence of doubt is enough to raise alarm bells. This leads us to a key lesson. Risk cannot be measured by a fixed formula. It can only be felt with experience and sensitivity. Like a veteran driver. No need to look at all the gauges to know when the engine is having problems. That intuition is trained over the years, through painful falls. However, knowing the risk is not enough, you must learn to control it. And control is not about eliminating it, but about keeping it within a framework that we can survive. This is where many new investors fail. They think that if they choose correctly, they will be safe. But the truth is no one can be right forever. What makes the difference is the ability to survive when we are wrong. Every investment involves risk. The question is not whether there is a risk, but whether I understand it and can I accept it. Risk control means before you take the step. We knew how much we could lose and were mentally and physically prepared to endure it. Great investors are not only good at making money, but also good at avoiding fatal blows. Their long-term success comes not from a few big wins but from avoiding the career-destroying losses of martial arts. It's not the fancy punch that keeps you standing, it's the steady defense. The financial world is full of shipwrecks of people who thought only of profits and forgot about risks. They eagerly rushed straight into the sea of gold and silver without realizing the undercurrents beneath their feet. Those who survive often report one thing in common. They knew fear, knew stop, knew defense. The highest profits sometimes come from rejection. Refuse to rush into an opportunity that is too attractive but full of pitfalls. Refuse to follow the crowd when everyone believes they will get rich quick. Each rejection is like another layer of armor. Protect you from the unexpected arrows of the market. Investing is not about finding treasure, it's about surviving long enough to see it happen. Those who patiently defend are the ones who ultimately hold the most lasting results. If there is a single guiding principle in the investment sea, it is intrinsic value. Value is not something that is obvious to everyone. It is like a vein of water flowing underground. To find it you have to dig, be patient, and analyze each layer of rock and soil. The prices are ostentatious right on the surface, always flashing, always demanding attention. Many people ignore value and chase price. They buy because prices are going up, sell because prices are going down. They think they are reacting quickly but are actually just puppets manipulated by the collective psychology. People who understand value are different. They don't care what the market is shouting today, they just wonder how far the current price is from the real value. Is it safe to enter? The relationship between price and value creates an interesting tension. When price is below value, you have an opportunity. When price goes too far beyond value, you have danger. It is this difference that creates the margin of safety. And smart investing is really just about buying when the margin of safety is thick enough. No complicated formulas needed, just keep the principles. Don't overpay for anything. No matter how attractive it may be, people are often blinded by promises of quick profits. But history is full of examples that these very promises often lead to tragedy. The tulip bubble in the Netherlands, the stock market bubble in the US, or real estate bubbles all over the world. It all started with people collectively forgetting the fundamental question of where real value lies. So what about the risks? The risk, as I have emphasized, is not the daily price fluctuations but the risk of permanent loss of capital. But the difficulty is that the risk is not posted warning signs. It never said I was coming here. On the contrary, it often disguises itself in a safe manner. In the stages everything is fine. The person with the second I will recognize. It is when profits become easy. When loans are given out indiscriminately. When the conversation turns to get rich quick. That's when the risks are piling up behind the door. When the crowd panics and sells off, when fear spreads like a disease, that is often when the risk has decreased and the opportunity opens up to control the risk. There is no other way but to set limits for yourself. That limit depends on each person. Some people accept higher risks, some choose absolute safety. But it is important to know clearly where you are and what you are facing. Many investors fail not because they choose the wrong company, but because they do not understand or do not dare to admit the level of risk they have accepted. I have met many people who boast that they always win big. They don't talk about the mistakes, the losses, but an investment profile that is all wins without mentioning the risks is the most suspicious profile to me. No one can eliminate mistakes, only survive mistakes. That's what makes the difference. Much of the wisdom in investing lies not in flashy decisions but in restraint. Curb your greed when you see prices rising. Curb your fear when you see prices fall, and above all, curb overconfidence in yourself. It is that restraint that keeps you from falling into the pit that the crowd rushes into. Investing is a game of mind, not a game of chance. It requires you to think at the second level. Understand that the market can be both right and wrong. A clear distinction must be made between price and value. And above all, consider risk control as a survival compass. If one day you ask me what is most important in investing, I will not answer profit but survival. Because once you lose capital, you lose your future and your survival. There is no other way but to control risk. Risk control is not magic but a series of conscious choices. Choose lower debt levels to avoid being swamped when interest rates rise. Choose a wider margin of safety so you don't fall off the cliff when the market turns. Choose to pass up on deals that seem too good to be true instead of going in blindly. Sometimes success is not about how much you do, but about how much you hold back. There is a picture I really like. Investing is like walking on a foggy mountain road. You can't see far ahead, only a few steps around you. So instead of rushing, you need to walk slowly, steadily, and always keep your balance. Those who run too fast, believe they know it all. Usually the first to fall. Risk often arises in consensus when everyone believes an investment is safe, that's when it becomes dangerous. Because prices have been pushed up, because confidence has eliminated caution. Conversely, when no one wants to touch a certain asset, when it is hated, considered hopeless, then the opportunity may lie there. But to go against the crowd, you need courage. It's not easy to buy when everyone is selling or sell when everyone is happy. Loneliness in investing is always harsh. But it is that loneliness that gives you the opportunity to be different. Good risk managers always ask themselves, what if I'm wrong? This is a simple yet powerful question. It forces you to look at failure, to face the worst-case scenario. And once you prepare for the worst, you won't panic when it actually happens. Many young investors tend to focus only on good scenarios. If the stock goes up, how much will I profit? But veteran investors are focusing on the opposite scenario. If the stock goes down, how much will I lose? And is there still a chance to stand up? It is this reversal in questioning that creates the distinctive character. Another lesson, risk control is not something you do once, it is something you do every day. Just as the captain of a ship constantly checks the compass and the wind, so too must investors constantly review their portfolio, always asking, is there anything I'm missing? Are there any hidden risks? That constant vigilance is your shield against unpredictable surprises. Risk control doesn't help you see immediate benefits. But it is what determines whether you go far or not. Like a mountain climber, he is not honored for carefully placing each step, but it is that carefulness that gets him to the goal. While the daredevil has fallen off the mountainside, if there is one thing that confuses new investors the most, it is that they think that risk and return always go together in a straight line. They believe that the higher the risk, the greater the return. But the truth is much more complicated. High risk does not mean high return, it just means higher uncertainty. You may win big, but you may also lose everything. The wise man does not seek high risks in exchange for the hope of high returns. They look for asymmetry. Situations where the potential loss is small but the potential gain is large. In other words, what they look for are mispriced opportunities, where the market price has drifted away from its true value and just a correction would pay off for the investor. But that opportunity did not present itself. It is hidden by the noise of the crowd, by fancy numbers, by embellished stories. To see it, you need a different pair of eyes. The eyes of second-level thinking. You don't just ask what people are thinking, you also have to ask what people are missing. Then you have to be patient. Be patient and wait for the price to drop to a reasonable level. Be patient to stay out when the market is intoxicated. Be patient to endure skeptical looks when you don't follow trends. That patience isn't flashy, it's not exciting, but it's the foundation of sustainable profits. Another important part is that you have to learn to accept not knowing. Many investment disasters happen because people believe they know it all. In fact, the market always contains hundreds of variables that no one can predict when you honestly admit that you do not know. You will be more careful and then you will be able to survive. Remember, the goal of investing is not to be a genius who is always right, but to be a pragmatist who is rarely wrong. If you are wrong less and when you are right big, you win. Therefore, risk control is not just a technique but a philosophy of life. It keeps you humble, forces you to guard against complacency, and reminds you that the market never owes you anything. You have to protect yourself because no one else can. Buy at A, sell at B. But investing is not like cooking according to a recipe, it is more like sailing a boat on the sea. You have to constantly watch the wind, waves, currents and adjust. The principles I share are not to guarantee you results, but to give you a chance to survive and go far. And if I had to sum up this first part in one message, it would be this. Learn to see deeper than the crowd. Understand that value and risk are central. And let risk control be your guide. Those who take it lightly usually have only a short journey. Only those who understand that can continue on the long journey where real opportunities await. Part 2, Facing Risks and the Market. When excitement pushes values higher than reason allows and when fear pushes things lower than reality. The important thing is not to try to predict the exact top or bottom, but to know where you are in the cycle. Realizing this is like walking into a room without anyone speaking. We still feel the heavy or exciting atmosphere taking over. Market sentiment swings like a pendulum that never settles at equilibrium. It swings from extreme greed to extreme fear, from blind trust to extreme skepticism. And it is in those extreme moments that disaster or opportunity appears, and if we forget that wavering, we will be swept away with the crowd. When Rio on the peak, then despair in the abyss. But if we are conscious, we can stop and look around and understand that perhaps we should slow down when everyone else is running and move forward when everyone else stops. The investment world is not short of negative influences and sensational news. People who are always confident that they are right. The urge to catch up with peers. All of which can easily cause us to lose our sanity. Fighting them is not easy. But that is a necessary condition to maintain independence in thinking. Sometimes the hardest thing is not finding information but blocking yourself from the noise from outside and the arrogance from inside. To achieve outstanding results, you cannot just follow the beaten path of the majority. But going against the flow doesn't mean always doing the opposite. It means daring to be different when the market is caught in extremes. When people believe that things will continue to rise, we must wonder what would happen if it were not so. And when despair spreads, we must dare to see what opportunities lie buried in the ruins. Rare opportunities often come from mispricing. An asset that is neglected, a business that is undervalued, that is a bargain. But to realize it takes patience, there is not always an opportunity. And the wise investor understands that most of the time should be spent waiting. That patience is not passive but a silent preparation so that when opportunity arises, we can seize it immediately and most importantly. We must accept the limits of our understanding. No one knows everything, and no one can predict the future accurately. Admitting I don't know is not a sign of weakness but the foundation of wisdom. It is from that humility that we can design strategies with a margin of safety. Instead of rushing into a risky path just because you believe you are omnipotent. Every market spiral is man-made and therefore inherently irrational as prices escalate. It is further believed that it will continue to escalate. When prices fall, that belief turns around, sinks into pessimism, logic is replaced by mood and the pendulum swings at full speed. This means that imbalances in crowd psychology often open up opportunities for those who dare to look differently. There is an uncomfortable paradox to extreme success. You have to be different but different is never comfortable. The crowd provides psychological safety that makes people feel right just because they are not alone. But the market often punishes those who follow that sense of security. Only when you dare to leave the ranks. Accept loneliness, we have the chance to find surprises. Of course, difference is only meaningful when it is right, but difference just to affirm the ego is meaningless, even harmful. Wisdom lies in keeping yourself alert to negative influences, but also not letting pride lead you astray. A delicate balance is needed, not passively following the crowd, but also not going to extremes of unconscious resistance. Instead, it is the ability to recognize when consensus has gone too far and when fear has obscured true value. Good investment opportunities rarely come along most of the time. The market operates close to rationality and everything is priced roughly accordingly. Therefore, investors must learn to be patient. Patience is not about sitting still and giving up, but about maintaining preparation, maintaining resources and spirit so that when the opportunity comes, we can act quickly and decisively. Opportunities come suddenly and disappear just as quickly. If we are not ready, we will only regret it when it is gone. In this journey, one of the most important things is to accept limitations. People hate to admit they don't know, but in investing this is the beginning of wisdom. The market is full of uncertainties from macroeconomics, politics, technology to human behavior. Anyone who is confident that they know for sure often falls victim to that same arrogance. Admitting ignorance helps us build strategies with safety buffers, spread risk, and never bet everything on a single assumption. True wisdom lies not in having many correct predictions but in avoiding fatal mistakes. In a world where surprise is the only thing certain. Humility turns out to be the strongest shield. People are often obsessed with timing. But the truth is no one can predict exactly the top or bottom. If you wait until all the signs are clear, the opportunity was gone. Conversely, if you jump in too early just because you think you're smarter than the market, you may burn out before the rewards appear. So the important thing is not to find the right magical moment but to know where you are in the cycle and act within the margin of safety. Patience is a competitive advantage. The market is driven by emotions and emotions are impatient. People always want to act, always want to prove that they are doing something, but sometimes doing nothing is the wisest action. Waiting makes us stand out from the crowd. And it is in that difference that the advantage gradually takes shape. People often forget that value and price don't go hand in hand. Sometimes the price is higher than the value, sometimes it is lower. That distance is fertile ground for opportunity. But to see that, we must accept that the market is constantly wrong. The tricky thing is that while the market is wrong, it is incredibly persuasive. Because it is the voice of the majority. To fight back, we need a strong foundation of faith. Based on careful analysis, not blind faith. If there is any formula for long-term success, it is knowledge combined with patience. Understanding helps avoid obvious traps. Patience helps us wait until the true value is revealed. But even with both, one more element is needed. Humility. Humility to admit that we can be wrong. Be humble enough to correct before mistakes become fatal. No one can know for sure what the market will be like tomorrow, but everyone can know how well prepared they are. Such preparedness includes keeping resources flexible, being ready for the worst-case scenario, and having the courage to act when others freeze. The real difference lies not in seeing opportunity but in being able and daring to seize it when it appears. And the biggest paradox in the word. Sometimes to achieve greatness, you have to learn to accept mediocrity for a long time, living with silence and feeling like you're missing out. While in fact you are preparing to not miss what is most important. What makes this journey difficult is that we never know when new opportunities will arise. Sometimes it's just a few weeks, but it can also be years. That period of time easily makes people lose patience, telling themselves that real opportunities never come, but the truth is that they always come, just not at the pace we want. So successful people are often those who are persistent enough to survive the wait and flexible enough to act when the opportunity arises. That waiting is not passive. It is a time to practice mindfulness, deepen analysis, and build a foundation. If you treat investing as a game of chance, you will soon be crushed by the market. But if you look at it as an intellectual journey, each day passes. Even if there is no deal, it is still an opportunity to accumulate insight. In fact, few people dare admit they don't know. Mayoral culture often celebrates confidence, grim predictions, and stark statements about the future. But it is those who dare say I do not know who have the ability to see far. They are not tied to a single scenario but open their minds to many different scenarios. And from there they build defense systems so that when surprises strike they won't collapse in this complex world. The important thing is not to win every round, but to avoid a fatal defeat. As long as you are on the board, you can always come back and win. But one reckless blow, one arrogant conviction that you are definitely right, can wipe out everything you have built. It is humility, which may seem weak, that becomes the strongest weapon for long-term survival. And looking back, we see that the big rewards in investing don't go to those who know for sure, but to those who are patient, who listen, and who accept limitations, and succeed. Ultimately it is the result of combining three seemingly opposite things: the confidence to act, the humility to defend, and the patience to wait. When we look at the market, we often see a paradox: the less opportunity there is, the more people want to do something. As if sitting still was a crime. They trade constantly just to satisfy the feeling of being in action, while that very restlessness eats away at their edge. On the other hand, the patient investor is like a silent hunter in the deep forest. Waiting until the prey actually appears is not laziness but the art of moderation, made more difficult by the noise from the crowd. The market is a giant machine that generates billions of signals, of which only a very small fraction makes sense, but humans are easily caught up in them. Overreaction to every short-term fluctuation, the press, social media, self-proclaimed experts, all contribute to amplifying the noise in that atmosphere. Keeping a clear mind is almost a never-ending internal battle. Most of the time the opportunity for superiority does not exist. The market usually operates around a reasonable level where everything is priced fairly. So much of success comes not from finding the secret formula, but from avoiding making mistakes when others lose control. Like a great goalkeeper, no need to score, just don't let in. But that doesn't mean we should give up. On the contrary, our task is to prepare so that when the unreasonable appears, we do not miss it. Preparation here is about maintaining discipline, allocating resources properly and especially practicing courage. Because when opportunity opens up, it often comes with overwhelming fear. Buying when everyone is running away is not the act of the weak heart. One must be both confident in one's own analysis and cool-headed enough to endure skeptical looks from all around. The art of investing, if summed up, is perhaps to accept long periods of silence and then focus all your energy on the brief moment when opportunity strikes. Most people cannot live through those lulls and thus never get their hands on the real rewards. The discomfort of silence is the test. Anyone can endure for a few weeks, a few months, but few can stay sober for years. And it is there that the market weeds out the impatient and rewards the few who have the courage to endure, not by being smarter but by being more patient, not by being quicker. But it is slow in time and has a paradox worth pondering. The greatest opportunities often come when the atmosphere is darkest, when the economy is in turmoil, when the news feeds are filled with bad news, when people no longer dare to hope. That is when price deviates most from value. The common man sees disaster, the brave investor sees fortune. But the difference is not in the ability to predict. But in preparation and courage. There are stages where just avoiding bad decisions is success. Preserving capital during tough times may sound tedious, but it creates a springboard so that when the storm passes, you have the resources to break out. This is an aspect that few people mention. Success comes not only from winning big but also from avoiding losing big deep down. Investing is a game of opposites, fear and greed, noise and silence, the many and the few. The wise man does not choose sides but learns to move between the two extremes. When fear prevails, they look for opportunity. When greed flares up, they cautiously step back. That flexibility does not come from instinct but from discipline and experience honed over years. It's not how many times you beat the market that matters, it's how often you do and let the market beat you. In a game where time is the harshest referee, that is true victory. The last thing to remember is humility in the face of the unknown. The market never ceases to surprise us, and every time it surprises us it reminds us that we are not perfect. Accepting this imperfection rather than denying it is the root of wisdom. He who believes he is always right will soon be eliminated. He who knows he can be wrong is likely to survive. Humility does not weaken us. On the contrary, it opens up options for us. When we are not too attached to a script, we can adapt. When we admit that we don't know for sure, we see the value of defense, of preparing for a variety of situations in a world where people are urged to be certain. The three words "I don't know" become an advantage. And it is from that foundation that real opportunity sprouts. We wait patiently, watching the psychological pendulum swing back and forth, recognizing when fear pushes prices down to irrational levels or when greed blows them sky high. We do not act because we want to appear smart, but because we recognize the mismatch between price and value. And when that moment comes, courage combined with humility will lead the way. Success does not lie in secret formulas or magical predictions. It is woven from long-standing patience, the ability to go against the crowd, the discipline to avoid mistakes, and above all, humility before the vastness of the unknown. It is not an easy path, but it is the only path for an investor to survive and thrive in this uncertain world. Part 3: The Art of Balance and Sustainability in Investing. I have always believed that in investing the most important question is not where the market will go tomorrow but where we are today in the cycle. Positioning yourself is not easy. It has no fixed map or clear signposts. But I've been through enough ups and downs to know. The market operates like the weather. No one can predict exactly when it will rain. But we know that when the sun is hot and sunny for a long time, the chance of a storm is higher. It is the sense of one's place in the cycle that guides action. Nothing is certain. Just be wary when profits come too easily. When the press is full of stories of getting rich overnight. That is a sign we are in dangerous territory. And conversely, when fear prevails, when no one wants to talk about risky stocks or bonds, that is often when the seeds of profit are sown. The important thing is to keep yourself alert between these two extremes, realizing where you are, even if the answer can only be approximate. I learned to look not just at numbers or graphs but at the collective mind. The conversations in the company hallways, the emails bombarding us with surefire product offers, the investment meetings where everyone exudes absolute confidence. It's all a signal. Complacency often signals a peak, while boredom often ushers in a new beginning. And then there is a truth that I am forced to admit. No matter how experienced you are, luck is still a factor. Luck is that silent companion that most of us only remember when it is gone. One time I was absolutely right about the fundamental analysis, but the timing was wrong and the results were just as wrong as the other times. I made a mistake in my judgment, but the school turned out to be favorable and I ended up being branded a genius by accident. It is the combination of ability and luck that makes me more humble. I never believed that a beautiful result was absolute proof of ability. A hit on target can be just luck. And a fall is sometimes a testament to the right thinking process. What we need to grasp is a consistent procedural approach to making decisions under uncertainty. The results will always be distorted by random factors. But the right approach will increase the probability of success in the long run. This is where I see the value of defense in investing. Many people may be engrossed in the dream of explosive profits, but for me, the most important thing is capital preservation. You would be surprised to know how to recover from a 50% loss. You need 100% profit. That number exposes the harshness of investment mathematics. One big mistake can swallow up a decade of effort. So my strategy has always been focused on survival. I choose the investment path like walking on a steep mountainside. Don't dream of sprinting, just slip once and you'll fall into the abyss. Instead, we need steady steps, balance, and patience, moving step by step. That doesn't mean avoiding risk, but managing it with sobriety. I leave the prize to those willing to race. I just want to get to my destination safely. Because reaching the finish line is already a great success in this brutal game. On that road, there are countless traps. The illusion of predictability. Overconfidence after a string of successes or blind faith that this time will be different. All is a deep hole. I have seen once brilliant fund managers go down the drain after just one wrong decision. I have also seen individual investors save up their entire lives and lose it all in one hot trend season. It is those stories that I remember. Sometimes victory is not in gaining more, but in avoiding losing it all. Every good investment decision is not a silver lining, which is often simply a mistake that does not happen. It is difficult to measure the value of avoided mistakes. But they are the foundation for endurance. Like the captain steering the ship through a storm, no one applauds when he avoids a rock. But the ship still floating on the water is the most convincing evidence. While investing is a game of probability, people crave certainty. We want to know if this investment will be successful, we want to hear a definitive answer, but the brutal truth, it certainly doesn't exist. All we have is a spectrum of possibilities, where the future can unfold in many scenarios and we are forced to live with that ambiguity. It is here that humility becomes a shield. The person who believes he has the absolute truth is often the most vulnerable when you think you know for sure. You will no longer feel the need to defend, and that is when the market will punish you mercilessly. I have learned to accept that no one can know everything. The important thing is to know what you don't know and to act in a way that allows you to survive in that darkness. People often make mistakes. They think success is the result of comprehensive understanding. Actually, success comes largely from managing the gap of unknown. I don't have to guess exactly whether the market will turn left or right. As long as I build a portfolio strong enough that if it turns left I don't lose everything and if it turns right I still get the reward. I have seen many investors fail because of one moment of overconfidence. They put all their capital into a forecast that they think is certain. And when the market turns the other way, their careers fall apart. The price of investment hubris is often not just money, but reputation, trust, and life. I always emphasize one thing: defensive investing does not mean fear or contraction. It is the courage to choose the more difficult path, refusing to rush into opportunities that seem brilliant but fragile. Instead, patiently wait for situations where the odds are in your favor. The profits are really in your favor. This sounds simple, but in reality it is a constant battle against greed and pressure from the crowd during bull markets, friends and colleagues. Even customers may look at me as an outcast when everyone is making quick money. Why am I slow when everyone keeps showing off huge profits? Why am I sitting still? But that is when perseverance is tested. I have to remind myself that my goal is not to win in a quarter or a year, but to sustain results over decades. And to go the way of the solution, I choose safety. I look for investments that even if things go wrong, I won't lose too much. A moderate but steady profit is always more attractive than a hit that can bring either quick glory or instant ruin. So if there is one single secret to surviving market storms, it is this principle. I often think of investing more like the game of Go than like the game of chess. Each move can decide victory or defeat instantly. In Go, the trick lies in controlling space, gradually expanding territory, and sacrificing small pieces to maintain a large position. Smart defense in investing is the same, not avoiding all risk but leaving yourself enough strength when the battle is long. If there is a moment in my career that I am most proud of, it is not the years of bumper returns, but the years when the market was in free fall and my fund survived. It feels like the helmsman steering the ship through a storm. You didn't finish faster than anyone else, but you saved your life. And that way you have a chance to continue your journey. I believe that successful investing is not only the art of choice but also the art of saying no. Refuse to follow the crowd. Refuse the temptation of easy profits. Refuse to believe that you can predict everything. It was that rejection that kept me in the game when so many others were eliminated. And there's one concept that I've always found to be the most misunderstood: risk. Most people equate risk with volatility. But the truth is that volatility is only a very small and often insignificant part. The real risk is the possibility of losing money permanently, the possibility of being taken out of the game. If you take a 50% drop and can't recover, even if the market recovers, you're still a loser. This is why I value margin of safety. Margin of safety is not an abstract concept. It is the buffer that helps us survive when things don't go as expected. I buy when the price is sufficiently below fair value. Because I know I can be wrong and when I am wrong. That margin of safety is the safety net that keeps a fall from becoming a disaster. But the paradox is when the market is excited. The margin of safety almost disappeared, stock prices were inflated, everyone rushed to buy and that buffer shrank to almost zero. This is when I choose to retreat, despite the laughter of others. They say I'm too cautious, too pessimistic, but I believe it's better to miss an opportunity than to risk survival in investing. Survival is always the prerequisite for success. I remember one time during the tech bubble, I got criticized heavily for not joining in the fun. Customers called to question, colleagues boasted of skyrocketing profits. I sat there holding cash, watching my portfolio not move much. That patience is painful because it means accepting the feeling of being left behind. But just a few years later, when the bubble burst, everything became clear. Whoever keeps the capital has the chance to start over. Long-term success doesn't come from winning a few big games, but from avoiding fatal mistakes. I often tell my colleagues, our job is not to be geniuses, but to not be victims. If you survive long enough, opportunity will come. But if you are eliminated in a shock, all your abilities and knowledge become meaningless. And there is something even more difficult than accepting patience, and that is accepting difference. Humans have a strong need to fit in, to keep pace with the crowd in investing. This is extremely dangerous because the crowd is often wrong and wrong at the most crucial moments. When prices spike, they rush in. When prices fall dramatically, they run away. To be successful, you must go against that instinct. But going against the crowd is never comfortable. It's like you're standing alone in a crowded market, watching everyone clap and cheer, while you silently turn your back. To do this, you must have deep faith in your principles. And most importantly, be prepared to endure loneliness. This is where defensive philosophy and margin of safety come together. They make you look slow, out of place, and even ridiculed. But time will tell. Investing is not a sprint, it is a journey. And on that journey, it is perseverance that gets you there, not temporary glitz. I realize that the nature of every market cycle is an alternation between greed and fear. It is my job to stay sober in both states when others are greedy. I have to be careful. When others are afraid, I have to be brave. It sounds simple, but in practice it requires iron discipline. Every day, the market seems to want to pull you towards your emotions, forcing you to react instantly. Fighting that storm is the biggest challenge. To be a good investor, you don't necessarily have to have brighter ideas than others. You just need to be able to restrain the wrong desires that others cannot resist. If investing is a race, then victory belongs to the one who makes the fewest mistakes, not the one who is the smartest. Whenever I think about investing, I always think of the image of a pendulum swinging constantly. It never stops at the balance point but always goes too far to one side before returning to the opposite side in finance. That pendulum is human psychology. Sometimes too fearful, sometimes too greedy. The average investor gets caught up in that volatility without even realizing it. And it's my job to keep myself from getting pushed too far with it. This is why I always emphasize recognizing your own limits. There are things we cannot know, and the more confident we are that we know everything, the more likely we are to fall. Decades of experience have shown me that humility is not a moral virtue but a survival weapon. Whoever thinks he can predict the future accurately, that guy is setting a trap for himself. So what should we do when faced with uncertainty? I choose to build a system of principles to help me make decisions in all situations. The system does not depend on prediction but on discipline, always requires a margin of safety, always thinks of the worst-case scenario, always evaluates risk before profit. It's like preparing a sturdy boat before setting out to sea instead of praying for calm seas and skies. I have seen many people collapse because of overconfidence. They predict that the market will continue to rise, that the current trend will not change. And when the opposite happens, their entire portfolio gets wiped out. The scary thing is that they not only lose money but also lose the confidence to return to the market. For me, losing capital is dangerous, but losing spirit is even more dangerous. The paradox lies in the success. We must accept that we will always fall short. Only when we understand our own limits can we build a reasonable strategy. I don't have to predict correctly every time. I just need to not let my mistakes get me down. That's why I always consider patience an irreplaceable quality. Be patient and wait for the real value to reveal itself. Be patient so as not to follow the crowd. And have the patience to accept the emptiness of time when there are no attractive opportunities. Many people think that success comes from constant action, from always doing something, but sometimes success comes from the ability to do nothing, from knowing how to stand still in silence. In fact, one of an investor's most valuable assets is the right to say no. Not with opportunities that aren't good enough, not with short-term temptations, not with market noise. Every time we refuse like that, we protect our capital and our sanity. I recall a time in my career when everyone is rushing into an asset class that they believe can't lose, the press is singing its praises, analysts are cheering, and clients are urging me to get in. I refused. That decision made me appear conservative, even incompetent. But a few years later, when the bubble burst, people realized that my silence that day was what saved them. This does not mean that I am always right or that I am immune to mistakes. On the contrary, I was wrong many times. But the difference is I always prepare for that possibility. It is that preparation that helps me stand firm so that when I am right, the reward will be enough to make up for the mistakes. And I think perhaps the biggest lesson I want to leave to anyone who takes this path is to build your own philosophy. No philosophy is perfect. But having a solid foundation will keep you from getting swept away in the whirlwind of chaos. Investing is not about finding perfection, it's about managing imperfection. When talking about investing, I often get asked, "So what's the most important thing?" The question sounds simple, but I have never come up with a single answer. The reason is obvious: investing is not a chess game with a few fixed pieces but rather a dynamic universe where thousands of factors interact at any given moment. One factor will become the most important and then the next, it may lose its significance. That's why I choose to see that the most important thing is never one. It is a collection of pieces whose value only appears when placed side by side, apart. They are just loose concepts put together. They become the panorama that helps us see clearly the nature of the market. For example, understanding risk is essential, but it is useless without patience. Patience is not enough without skepticism to counteract common illusions. And all of that becomes unclear if we don't keep reasonable expectations. Each piece needs other pieces to complete it. I often call this dynamic balance, a state that is not fixed but always changing depending on the context. Today's risk control may be most important tomorrow. The ability to keep calm in front of a crowd is what makes the difference. Successful investment, so it's not about sticking to a single principle, but about being able to move between principles without losing the core frame of reference. I understand that many people want to hear a neat formula: just do A, B, C and you win. But it was this urge to find the formula that led them to failure. Investing is not like cooking from a book but like steering a boat in the middle of the ocean, where the wind and waves are always changing. No formula stays the same forever. Only sanity knows when to change sails, when to lower them. The more we crave certainty, the more likely we are to fall into the trap. When we accept uncertainty, we find freedom. That freedom allows us to improvise rather than being confined to one single, most important thing in our years of experience. I have seen exceptional people who understand that investing is a game of flexibility. They are not rigid in holding on to one belief but also do not change with the wind. They are like experienced musicians who know when to push their instruments to a climax and when to back off to keep the beat. Speaking of this, I remember a detail: many investors fail not because of lack of knowledge but because they do not know how to combine knowledge into a whole. They see the pieces but not the picture. They know about value but not psychology. They understand psychology but lack patience. Each small pink hole when stacked creates a giant gap. Therefore, I believe that success does not come from the ultimate secret but from combining many elements in your own unique way. Each person has to find their own rhythm based on their own experiences, personality, and mistakes. I myself am not an exception to that rule. I made a lot of mistakes, and it was those mistakes that taught me how to put the pieces together into the system I follow today. This is perhaps the most important confession I can make. No one can give you a single key that opens all doors. You must generate your own key set. One point I return to again and again in my thinking is the role of second-order thinking. This is the foundation of everything I believe in. I have seen many smart investors, with degrees and knowledge, but failed because they only stopped at the first level of thinking. They see a company doing well, they buy; they hear interest rates are down, they jump into the market; they read a bullish report, they rush into action, all correct on the surface but lacking in depth. Second-order thinking is when we ask not just what is happening, but how everyone will react to this and what the ultimate consequences will be. It requires a step back, a separation from the general flow to see not only the phenomenon but also the chain reaction behind it. Imagine the market as a card game. If you and everyone else sees a card clearly, its value is almost zero. The advantage comes when you can see the hidden cards or predict how your opponent will play. Investing is the same. Public information rarely gives an advantage. What gives you the advantage is how you interpret that information differently than the majority. I remember one time during a financial crisis, everyone rushed to buy government bonds because they considered it a safe haven. At first thought, that makes perfect sense. But the second floor showed me a paradox. When everyone rushes in, yields will be forced down to unattractive levels. As a result, what seemed like a safe place turned out to be a place where you were definitely not going to get what you deserved. Second-order thinking often forces you to stand alone. It makes you question things people take for granted. It forces you to wonder if the obvious really gives you an advantage. Or is the obviousness itself a trap? This is a lonely and not easy road. Because humans crave conformity, but if you want to excel, you can't walk the crowded path. I used to say that investing is an essay contest. The main judge is the market crowd. They don't grade you on how good or bad your essay is, but on how much better or worse it is than the majority. You don't need to be right in an absolute world. You just have to be more right than the majority. And to do that, you have to think differently. Finished. Thinking differently doesn't mean always going against the crowd. That is another pitfall. If everyone is optimistic, you don't have to be pessimistic just to be different. The key is to think deeper, not simply the other way around. Second-order thinking is not instinctive opposition, but to find a perspective that the crowd has not seen or is not brave enough to follow. I know it's easier said than done. Second-order thinking requires patience, constant practice, and the ability to endure loneliness when the market temporarily turns its back on you. Many times I have been called a pessimist and a missed opportunity. But time has proven that it was my persistence with deeper levels of thinking that saved me from terrible crashes. Thinking about this, I realized another paradox. Competitive advantage in investing often comes from discomfort. You can only excel when you dare to step into areas where others hesitate. That discomfort can be staying on the sidelines when the market is euphoric or patiently buying when everyone is panicking. Regardless, it requires you to be willing to go against your natural instincts. And it is here that second-order thinking connects with all the other elements I've mentioned. You can't think at the second level without skepticism, without risk management, without setting reasonable expectations. It is the convergence of all the pieces, insight, humility, and patience. As I write this, I see one thing clearly: all the scattered principles, experiences, and observations I have mentioned finally come together into a unified picture. And that picture is not glossy, it does not promise absolute certainty, but only points the way to greater wisdom. Investing wisdom is not about winning every battle, nor is it about finding the secret formula to getting rich quick. Wisdom is simply surviving long enough, keeping your wits about you while others lose their way, and taking it one step at a time. Then after many years, the results speak for themselves. I know many people enter the market with the desire to get rich quick. They want definitive answers on what to buy and what to sell. What is the secret of invincibility? But if you have patiently read this far, you must have seen that there is no such key. All we have is a set of principles. Skepticism to avoid getting carried away, humility to admit you don't know, patience to wait for the right moment, discipline to take risks, and courage to think differently. An investor asked me, "So what is the most important thing in the end?" I replied that it varies depending on the circumstances. Sometimes it is important to avoid risks, sometimes it is important to wait patiently, and sometimes it is to dare to seize opportunities while others run away. And sometimes the most important thing is simply to keep your mind steady and not let greed and fear lead you. The title of this book is therefore not ironic. It speaks a harsh truth in investing. There is never a single truth. The most important thing is not a fixed answer but an open question. Force you to answer yourself in each specific situation. Keeping the question alive is the key. Invest the way I see it. It is more of an inner journey than a hunt for profit. It tests your perseverance, courage and self-reflection. Numbers, charts, pricing models, all the rest are just tools. The decision lies in having the courage to think, to be independent, and to act on your beliefs, even when it's uncomfortable, even when it's lonely. When I think back to the volatility I've experienced from market shocks, bubbles and bursts, and panics across the streets, I'm not proud of having been right every time. I pride myself on being principled, knowing when to stand aside and when to step in. That's why I'm still here, still learning, still strong enough to share with the next generation. If there is one last thing I want you to take away, it is that investing is not about proving you are smarter than anyone else, but about protecting and nurturing your own future. And to do that, you need more alertness, independence and patience than any formula. I said at the outset that this book is a collection of scattered notes and lessons learned throughout my career. Now, in closing, I realize that it is this fragmentation that reflects the nature of investing. It's not straight, it's not simple. It is a complex series of pieces and the wisest person is the one who knows how to connect them into his own picture. And so, this journey never ends. What is most important today may not be most important tomorrow. Our only task is to continue to reflect, continue to question, and continue to maintain the humility necessary to learn more. Thank you for choosing this book journey with me. That journey does not promise us a fixed formula but opens up pieces of thought for each person to put together for themselves. If you've listened this far, perhaps somewhere in the story has evoked a pause for thought, a new perspective for contemplation. I cherish every moment you spend there. If possible, I hope you will leave a few lines of your review or feelings about the book, not only to record a reading experience but also as a way of dialogue so that even though we are strangers, we can still reflect on each other's thoughts through this book. And if you have another book in mind, a book that's been bothering you or a book you'd like to read a little more, a new perspective, please suggest. Who knows, maybe your next journey will start from that very suggestion. Read, think and share. That's how we make ideas never die.